The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, 2025 is set to be a pivotal year for corporate real estate. With rapid shifts in geopolitics, technology, and workplace expectations, the industry is not just evolving, it's demanding proactive change. The year ahead requires more than just adaptation. It demands strong leadership. So what are the key trends that will challenge the expertise, flexibility, and foresight of CRE professionals? Well, to find out more, joining me now is Dr. Lee Elliott, head of Global Occupier Research at Knight Frank. Dr. Elliott, thank you so much for joining me today.
My pleasure, Hongbin. How are you?
I'm good. How are you?
All good, thanks. All good.
All right. Well, Dr. Elliott, just want to start off this interview by asking you, how has the landscape of investing in corporate real estate changed over time, and what will be the key trends that will drive this market in 2025?
Well, I think, corporate real estate used to be about square footage and cost per desk, but in 2025 it's going to be about adaptability, resilience, and actually strategic firepower, because what was once seen as a back office function is now very front and center of business strategy. Our report, Changing Tack, sort of makes it clear that corporate real estate is going to shape how companies attract talent, how they embed and galvanize culture, stabilize supply chains, hit sustainability targets. It's mission critical. It's not operational. It's directional. It sets the tone for businesses and their workforces going forward. So we think 2025 is a defining year for corporate real estate. We've had several years from the pandemic onwards of occupiers buying time, kicking the can down the road. But we think, we've now got to see real estate leaders within corporates moving from a wait and see to an act or fall behind sort of posture.
I see. Well, Donald Trump's return to the White House has also brought in another trade war here. How do you see the potential impact of rising economic nationalism and trade wars on the corporate real estate market?
Well, I think undoubtedly with Trump back in the White House and sort of the whipsaw policy that we're already seeing in play, economic nationalism is not just going to reshape trade, it's going to redraw corporate real estate, the map that occupiers have globally. It's worth noting that what we're seeing playing out at the moment around the world is really a reaction not to Trump version 2, but arguably Trump version 1 and the policies that Biden took on around nationalism. So there's another wave of this probably to come. But our report makes it quite clear, sort of an America first agenda means tougher tariffs. It means renewed decoupling from China, pressure on traditional allies, and corporate real estate is going to be a platform not only for growth, but for buffering against geopolitical risk. It's kind of where that point around resilience comes into play.
I see. Well, with increasing tariffs and reshoring policies here, how do you think global supply chain disruptions will influence site selection and corporate real estate, strategies?
Well, I think, to use an analogy, the global supply chain used to be a bit of a spider's web. It was very delicate, it was far-reaching, but as we saw through COVID and beyond, pretty easily broken. I think now what we're seeing is companies weaving something a lot sturdier, sort of a safety net, if you like, and what we're seeing is protectionism rises, overseas markets become more volatile. You're seeing more nearshoring of critical functions or other variant of shoring such as friendshoring or greenshoring. And that's particularly pronounced here in APAC. Rising shipping costs, political risk, regulatory divergence, they're all leading occupiers to create sort of multi-locational strategies. Vietnam, for one, has been a real beneficiary of that sort of approach. And we expect to see, those locations offering proximity to ports and airports, Johor, Chonburi, Batam, they're all going to become more strategic than ever as we sort of see organizations reset their supply chain.
Right. And of course, we're in an environment of uncertainty, which in turn causes a lot of volatility in the market. How should corporate real estate professionals then navigate the heightened volatility caused by interest rate fluctuations, inflation, and geopolitical tensions in 2025?
Well, I think I've sort of already alluded to it, that we can't continue to kick the can down the tracks within corporate real estate. In this kind of market, unfortunately, it's not about riding out the storm. It's about sort of leaning into the wind a little bit. And I think what we're likely to see is, and as the report highlights, volatility is kind of the new normal, not a phrase I particularly like, but it's true that we're seeing more volatility. And I think professionals that are going to thrive are those that sort of get into scenario planning, dynamic modelling, and agility as sort of core competencies. We need a move towards, and are already seeing a move towards more agile leases, flexible space, and faster decision making. Because I think if you're waiting for calm waters, you're going to be left behind in this marketplace.
I see. So what role do you see scenario planning and dynamic risk management playing in corporate real estate decisions this year?
Well, I think we've seen more scenario planning taking root in the corporate real estate profession. It's understandable, corporate real estate decisions aren't made in a straight line anymore. They're very much made in shifting terrain. So I think what we're now seeing is the gaze of corporate real estate leaders, if you like, is across multiple dimensions: economic, geopolitical, environmental, and you have to stress test plans, actions, strategies, build optionality into leases, and try and use as much data, something that the real estate sector has not been great at historically, but using a lot more real-time data to try and adjust course as events take place.
I see. Well, Dr. Elliott, artificial intelligence is expected to have a significant impact on the real estate industry this year as well. How should companies then balance the risks and rewards of implementing AI in their real estate portfolios?
Well, I think we've heard a lot about AI over the last couple of years. We're now getting to the sort of sharp end of implementation. I think corporate implementation of AI rather than personal implementation of AI is a much slower process. Lots of reputational risk, lots of cost, lots of worry about obsolescence of AI products that are rolled out at a corporate level. But no doubt, AI could be a lighthouse or it could be a lightning rod. It depends on how you build the system. And I think what we're likely to see with AI in the corporate world is a growing use of AI to provide occupancy insights. But it's ultimately about the foundation being solid. And one of the things that we have in corporate real estate, which is a challenge, is really poor data. And, you can have as many AI tools as you like, but if you don't have the fuel of data, I think that's a real problem. A lot of our clients now are getting really heavily into analytics, which, of course, we're helping with, and really starting to get into the nub of the issues rather than sort of relying on gut feel or opportunism, which is probably how the market has worked historically.
Well, on that note, since data seems to be key here, what opportunities do AI-driven analytics then offer for identifying high-performing assets and predicting market trends in this real estate sector?
Well, I think we're sort of in the foothills of our journey in AI, but I think where we're likely to get as 25 progresses and beyond is, space starts to talk back a little bit. We're starting to see smart buildings and data-enabled buildings, IoT starting to take hold alongside AI, and the smartest occupiers are going to be listening to that feed of data that comes from their buildings to understand how space is being used, what space is being wasted, and where they can enhance performance. So, what we're saying in the report is we think long-term there's a move towards more predictive analytics as the next frontier. We're a little way away from that at the moment, to be brutally honest, but I think that's going to be the new edge.
I see. Well, other than AI here, sustainability is also a key trend this year as well. How do you foresee the evolution of ESG in corporate real estate strategies, particularly as businesses face rising costs for green building projects?
Well, it might be about the cost of not acting sustainably, if you take a longer term perspective. And I think one of the challenges we have with the sort of ESG agenda in real estate at the moment, the political climate, particularly stateside, has changed quite markedly. Right. But I think if you sort of peel back the rhetoric and start to look at reality, I think what we're seeing is occupiers not seeing sustainability as a side mission, but actually really on the main stage. And yes, there are cost pressures, but ESG is becoming a baseline expectation from stakeholders, shareholders, employees, regulators. And it's good business practice to build resilience into your real estate portfolio to make sure you're protected from some of the big changes that are happening in the climate. And it's not just about the ESG either, big issues around social and governance as well. We're seeing a lot more engagement with local communities from businesses, recognizing that they're almost custodians of the locations that they now choose to operate in.
I see. Then what do you think will be the biggest driver for companies to prioritize sustainability in their real estate strategies this year?
Well, just look at what's happening in Myanmar and South Korea right now. Climate risk, it's not an abstract threat. It's showing up all the time. It's going to show up in insurance premiums. Occupiers are going to be hit by rising costs and rising. And I think our report warns of how to act in facing financial exposure, then, there's going to be reputational damage, there's going to be growing scrutiny. We don't think the biggest driver is regulation, it's actually resilience. It's about companies trying to create sustainable space because it's sustainable space that will survive.
I see. Overall, then, what key factors should corporate real estate professionals consider to, future-proof their portfolios in 2025, ensuring long-term resilience and amid ongoing economic and technological shifts?
Well, I think it's a much more multidimensional occupation now, corporate real estate. It's no longer, as I said at the start, about cost control and square footage, although those are important metrics. I think really what occupiers need to start doing is, and the real estate leaders start thinking in layers, if you like. How do you build flexibility? How do you regionalize rather than globalize in this new world order? How do you bring ESG to bear? How do you use data? And how do you, I think it's probably the critical one, how do you align the speed of business strategy and decision making with the speed of real estate? They're mismatched at the moment. So that's why we are seeing that move towards shorter lease terms, for example. So future-proofing doesn't mean building for permanence. It means building to be able to evolve. And I think that's where most occupiers that I deal with on a day-to-day basis are really starting to focus.
I see. And finally, Dr. Elliott, how can CRE leaders foster innovation and resilience in their real estate strategies amid such rapid changes in the market?
Well, I think it's linked to the point I just made, which is that I think the best corporate real estate leaders over this year and beyond won't be space managers. They'll actually be change managers.
Okay.
I think it's really important to think about innovation, not just as a tech play. I mean, it's often about a mindset, challenging the orthodoxy, if you like. And what our report does is challenges occupiers to sort of embrace disruption, not to park it, but to sort of dive into it, rethink how space is used, why it exists, and who it serves. Because whether it's adaptive reuse, AI, ESG, resilience is going to come from those bold enough to reimagine, not just rearrange their real estate.
I see. Well, thank you so much, Dr. Elliott, for your time and your insights today.
Absolute pleasure.
Thank you. That was Dr. Lee Elliott, who is the head of Global Occupier Research at Knight Frank. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.